Thank you for joining us today. We're going to cover self directed 401k and other employer plan strategies. My name is Alex Perney. I've been with Advanta since 2012, and I'm happy to help you with any questions that you may have regarding choosing the right type of employer plan or any questions regarding 401ks. So, what is an employer sponsored plan? Well, it needs to be something that has a business attached to it. Most people do tend to confuse these with IRAs, but a self directed 401k, SEP IRA, and simple IRA plan exists to assist employers in retaining employees and to help their employees become financially independent with the retirement plans. Now, these are nothing new. 401ks and traditional IRAs have been around since 1974 with the passing of ERISA, which is the Employee Retirement Income Securities Act of 1974. Now, there are a few key components that you need to understand with regard to an employer plan. That is the sponsoring business, whom the participants and employees are in relation to the plan, and how to make contributions. The sponsoring business is the entity that creates the plan for the benefit of its employees. This can be an LLC, a C Corp, sole proprietorship, or many other different types of businesses. The participants or employees are the ones who are actually going to utilize the plan, and they can be any eligible employee, business owner, spouse of a business owner, and several other types of people that work for the company that we'll get into a bit later. And under some plans, not all employees would qualify to be included. The contributions or the money that you add into the plan can include voluntary funds contributed from each employee. They can include funds contributed by the employer, and different plans have different limits and formulas for these contributions. Now, there are three essential plans that we're going to be covering today. They are the solo 401k, the simple IRA, and the SEP IRA. And they are all not created equal. Some can greatly affect the way you contribute cash and administer the plan, and different plans allow for corporate deductions, and some may also allow for personal deductions as well, meaning where you actually take the reduction in income, whether it be on the personal side or the corporate side of your tax filing. And some of these plans require employee contributions to receive an employer contribution match, and others do not. Specifically, those are going to be tied to the simple IRA and the Roth, or sorry, and the 401k specifically. And self directed employer plans, again, can include SEP IRAs, simple IRAs, and 401k accounts. Now, a big part of this is the impact of other employees that will determine what type of plan you ultimately are going to choose. You're going to need to understand what type of employees need to be covered, whom can be excluded, and who is most likely going to participate in the plan. So, what types of employees are excludable from an employer based plan? They're going to be individuals under the age of 21, non resident aliens of the United States, and unionized employees that are covered by collective bargaining agreements. Now, what type of employees must be included? Well, with a solo 401k, it is going to be those workers who work at least 1,000 hours per year, or, according to the newly enacted Secure Act as of 2019, at least 500 hours over 3 consecutive years. With a SEP IRA, it's those who have worked at least 3 of the last 5 years, constituting a full time employee. And a simple IRA are those who have received at least $5,000 in compensation during either of the last 2 years. Now, it's important to understand that there are many different types of retirement vessels that you can choose, and choosing a qualified plan or an IRA is going to be a very large decision to make. Now, some of the points to take away in choosing the plans are as follows. With a 401k, there is no special discrimination testing for an owner only business, meaning that you do not need to employ third party auditing to ensure that all participants are being treated equally and the plan is being equally and equitably offered to all eligible employees. This can certainly drive up the cost of administering a plan if you have more than just owner operated employees or owner operators that are working for the company. If any rank and file employees are present, a good example is if they are a W 2 employee, then the special testing must be done. SEP and simple IRAs have their own unique set of requirements as well. A simple IRA can only cover up to 100 employees. However, a SEP plan can cover an unlimited number of employees for your business. And please note that the administrative costs associated with scaling a business can directly affect the cost of administering that plan. Now, the solo 401k gets a lot of press for being a great option, and for many people, it definitely is. However, the SEP IRA and the Simple IRA have their own set of advantages. Both of these plans are less expensive and easy to administer from the aspect of total cost for the employer. The contributions are made to IRAs. You maintain no fiduciary liability for the most part with these types of plans, meaning that you, as the employer and the sponsor of the plan, are not legally obligated in certain instances uh, to carry liability for the actions of the plan. Now, that is a whole other presentation for another day, but if you want to look into it further, there are fiduciary liabilities that come with being the trustee of a 401k that are not present with SEP and simple IRAs. Now with SEP and simple IRAs, individual employees choose their IRA custodian. There is not one prescribed custodian that they must administer with. You can have the plan set up with any custodian that is qualified to hold that type of plan, and they are portable from one custodian to another. So multiple employees can hold their SEP accounts or simple accounts with multiple different custodians. The employer contributes only to those employees with more than 2 years of service for a simple IRA and 3 years of service with a SEP IRA. So remember, the SEP and simple IRAs are going to be a great choice if you have employees that want choice in where they hold their assets, and if you have a business that has a lot of employees. Now, there is certainly advantages to the 401k plan, and some of those advantages include higher funding limits than either of the other two plans that we covered. So you can actually put in more money on a maximal basis every year with a 401k. You can defer a larger amount of your earned income via the employee contribution and the employer contribution. So there are two parts to making a contribution into a 401k plan. There's different opportunities for rolling over other types of plans into, and then what you get to roll into out of with a 401k plan. You can access tax-free loans from the 401k. Unlike the SEP IRA and the Simple IRA, you are allowed to borrow against a 401k. Currently, with the CARES COVID Act, you can take out up to a $100,000 loan that has to be repaid over 5 years from a 401k plan. Previously, it was $50,000 over 5 years, and you get to pay that back at a point above or below prime. So it's a very attractive offer. So if you would like to access those retirement funds early, but do want to pay them back, and you get to escape UBIT tax for leveraged real estate investments, and they are certainly very cost effective if it is an owner operated business. And one very big key difference between the SEP IRA and the simple IRA to the 401k plan is that you can have a Roth 401k where you get completely tax free growth and tax free distributions from the plan. There is only traditional tax deferred contributions that can be made to both a SEP and simple IRA. Now, the plan contribution limits currently for the year 2020 are as follows. It is $6,000 for those individuals under the age of 50 and a half for an IRA and a Roth IRA, and a $1,000 catch up if you're over the age of 50 and a half. If you have a SEP IRA, you can contribute up to $57,000, which is constituent of a representation of 25% of your total compensation. So you can maximally make up to a $57,000 contribution, but it cannot exceed 25% of your compensation. With a simple IRA, you can contribute $13,500 of your current earnings and an additional $3,000 if you're over 50. Now there is a employer match to this, and it can be up to 3% of what you are contributing as the participant. With a 401k, although it is a little bit more complicated to determine your total contributions, you do get to make more of them. So of your earned income, the money that you're being paid out as salary wages from the business, you can contribute up to $19,500 of that type of income to the plan directly, with an additional $6,500 catch up if you are over 50. And you also get to contribute 25% of an employer match to the plan, which is made up of the net operating income of the business, which can be up to $35,000. So if an individual is over the age of 50, they can totally contribute $63,500 per year into a solo 401k. Now, the other two that I have listed up here are going to be the ESA or the Coverdell account, which is still $2,000 per year per child, and health savings accounts, which are $3,550 for the individual plans and $7,100 for a family HSA. Now, a contribution comparison. It's important to note that with these types of plans, the mathematical approach to looking at it only makes so much sense unless you're actually given a real world example. So in this example, John is a sole proprietor whose 2020 salary is $100,000. Which plan is going to be right for John? So how much could he contribute to a simple IRA, a SEP IRA, and a solo 401k? Well, with a simple IRA, if he's making $100,000, he can contribute $16,500 of total contribution, which is made up of $13,500 of salary deferral plus a $3,000 employer match. With the SEP IRA, he can contribute $25,000 total. Because remember, he can contribute 25% of his earned income, which is $100,000, to that plan per year. Now, with the solo 401k, albeit a harder calculation, he can contribute much more. He can contribute a total of $44,500 to this plan on an annual basis. He can contribute $19,500 of his salary plus $25,000 from his employer match to the plan. Now, if John were over the age of 50, he could contribute an additional $3,000 to a simple IRA, no additional funds to a SEP IRA, and an additional $6,500 of salary deferral to a solo 401k. So, with that said, depending on how you're earning your money and how you want to defer your taxes, the solo 401k is going to allow you the most contribution limit, but you are going to be splitting where you take the deductions in that type of plan between yourself personally and the employer. Whereas with the SEP, you do get to wholly reduce the amount of income that you're being paid. Now, there are a few different ways to administer certain plans. With SEP and simple IRAs, there is no ability for you to self administer the plan. You have to have a dedicated custodian that handles the plan for you. Now, with a solo 401k, you have a few different options. As you are the trustee of the plan, you do have the option to self administer and self custodize the assets. While you can certainly pay us at Advanta to do the actual record keeping and bookkeeping of the plan for you, if you would like to hold things a little bit tighter and maybe reduce your fees a little bit, you can do what is called a do your own 401k. And it's really going to boil down to how much control you want and how much service you actually want to have secondarily, which you think you may or may not be able to do yourself. So cash and assets can be administered by Advanta IRA as a third-party administrator or directly by John as the trustee of his plan. In both scenarios, assets and investments are held in the name of the plan. So John Smith as trustee of ABC 401k plan. John, as trustee, signs all documents in both models. So whether he is utilizing us as a third-party administrator or a do-your-own plan, he is still going to be signing everything. And DYO plans have a trust account at a local bank as opposed to holding cash directly here at Advanta as a third-party administrator. In this case, allowing John to write trust checks directly from those bank accounts himself. If John uses a third-party administrator to hold the funds, he will need to request the funds from the administrator to make investments, pay bills, etc. And all the income from any investment in either scenario is always going to be non-taxable to the plan. Now, moving money into one of these types of plans, we've covered how to contribute money, but if you already have money in an existing type of retirement plan, it's important to know how to actually get those funds into a qualified plan. Now, transfers and direct rollovers are the two mechanisms that you're going to utilize. Moving funds directly from one retirement account to another without the client handling the funds is going to be a direct rollover or a transfer. However, a transfer is strictly from an IRA to an IRA, and it is not reportable. And a rollover is done from a 401k or into a 401k from any other type of plan. Both of these movements are non-taxable, and remember, there is no tax reporting done for transfers, and there is minimal reporting done on rollovers. Now, there are many different types of investments that you can do with a self-directed qualified retirement plan. You can invest in real estate, whether that be vacant land, rental houses, fix and flips. You can invest in notes and mortgages, whether that be a first position, second position, or an unsecured loan, multi and single member LLCs, private stock and private placements, foreign currency, futures, and other things like tax certificates, structured investments, oil and gas rights, and commodities. Now, for not every investment are you going to be able to pay with the entirety of cash for the purchase. Namely, real estate is one where a lot of people will look to finance the purchase. Now, there's special considerations to give when utilizing non-recourse financing within a qualified retirement plan, and a specifically very big benefit for a 401k. All employer plans can use leverage. All financing for these employer plans must be non-recourse. You will need to understand how UBIT and UDFI, which stand for Unrelated Business Income Tax and Unrelated Debt Finance Income Tax, are calculated and where they apply. And different plans can use leverage with different considerations. The primary example being the exemption of having to pay UDFI for newly acquired real estate within a solo 401k plan. And no personal guarantees can be given, and penalties for doing so can vary widely between these types of plans. So, to understand a little bit more about what UDFI is, SEP and simple IRAs will have to pay this tax. It's the amount of income derived from the leverage portion of the asset will be taxed. The tax is assessed at trust rates, and the plan must file IRS Form 990T in order to pay the taxes. You personally, as the account holder, do not pay them out of your personal funds. The proportion of tax paid on profits will decrease according to the debt ratio of the underlying security and eventually will go away once the property is owned free and clear. For 401k accounts, for the acquisition of new real property, a 401k account is exempt from paying UDFIT taxes. If you operate a trade or business underneath a 401k, however, you may still incur unrelated business income tax liabilities. So, for example, if you bought a laundromat or a gas station in a 401k, you would owe unrelated business income tax. However, if you only bought the property and then rented it out utilizing leverage, you then would not have that tax applied. Now, let's look at a few case studies in the real world to show finance real estate utilizing an IRA or a 401k as a down payment. In this deal, Mike is going to be purchasing a piece of rental property with his SEP IRA worth $160,000. Mike finds a house for $150,000 that doesn't need much repair work. Mike uses $60,000 from his SEP IRA as a down payment and finances the rest with a non-recourse loan so we can buy two properties. Here's the details of this investment. The loan is $90,000. It is 6% fixed rate and amortizes over 30 years. The monthly payment the SEP IRA needs to make is $540. That amounts to $6,500 annually in payments towards this loan. Mike cannot guarantee the note personally, and thus the bank can only foreclose on the property owned in the IRA. The loan is to the IRA directly, and the IRA repays the loan out of the account. Lenders for non-recourse loans typically want about 30 to 40% down with cash in reserve. Keep in mind that these are not necessarily the most common types of loans, so it's not going to be something that you're going to go to a large commercial retail bank. We can certainly provide you with referrals of people that can help you with non-recourse loans, so please do keep that in mind. For IRAs, income received on mortgaged real estate is subject to unrelated debt finance income tax, or UDFIT. For solo 401k accounts, UDFI and UBIT does not apply at all in these situations. Only income based on the percentage of financing is subject to tax with IRAs. Percentages decrease as loans get paid down, and the IRA files IRS Form 990T when it needs to pay these taxes. And the nice thing about that is that the IRA, unlike when it pays cash, can actually deduct percentage of expenses and depreciate the property as well. However, if the total UDFI liability is less than $1,000, then no 990T needs to be filed. And keep in mind that these taxes are paid at trust rates. So here's the tax impact of using financing with an IRA or a 401k on one property. With utilizing a SEP IRA, the total monthly rent is $2,000, so that is $24,000 per year. The loan is $6,500 per year. Expenses, 25% of rents is $6,000 per year. The net prior to paying unrelated debt finance income tax is $11,500. The net income subject to UDFI for the SEP IRA is $6,900, and the 28% tax rate that is going to be paid on these funds is going to be just shy of $2,000 at $1,932. So the total income minus taxes that the SEP IRA is going to be enjoying is going to be $9,568 per year. Now let's look at this through the lens of utilizing a solo 401k. The total monthly rents are going to be $24,000. The total loan payments are going to be. So a little bit about Advanta IRA. We're experienced with almost 20 years of industry expertise. We are one of the nation's premier self-directed IRA administrators with certified IRA service professionals, self-directed IRA professionals, and attorneys all on staff. Any cash that is held by Advanta is FDIC insured up to the applicable $250,000 limits, and currently our clients hold over $1.3 billion of assets that we administer for them. And every IRA that is here with Advanta, whether it's an IRA, 401k, SEP IRA, or simple IRA, has a dedicated account manager who provides concierge-style personal service. Advanta IRA also offers cutting-edge education tools for all types of investors. We encourage everyone to check out our Learning Center. Our events are held almost bi-weekly. We have a robust video library on YouTube that will help you with any questions that you may have on a particular investment that you can do through a self-directed IRA with many wonderful guests. And we have the latest industry news constantly updated on our blog, so please check those out as well. And getting started is as easy as just picking up the phone, getting some paperwork, and sending it back in. Takes about 15 to 20 minutes unless you're doing a 401k, in which case we do need to schedule a consultation. So please give us a call. Funding your account and investing are incredibly easy, and we'd love to help you through the process. Again, my name is Alex Perney. If you have any questions, please feel free to give me a call. My direct line is 727-754-9954.